Hello there. Gee, Anna is accusing Jimmy of sexual harassment. Jeez. Hi, Kay. How are you? Hi, Lana. Good to see you. Hi, Carmen. It's good to see you. Thanks for sharing. And Dolores, thank you for coming. Thank you for coming both to Facebook and to YouTube. Kay says hi, Steve Gonzo and Dolores Pierce. Steve Gonzo says, How to Destroy a Media Company in 1 Week by Cenk Uygur. They must be having real bad problems. Amber says, Good evening, my lovelies. I hope you're feeling better, Dr. Joe. Was I feeling badly sometime in the recent past? I can't recall. But thank you, Amber. I think I am feeling fine now. Steve says hello, all. Steve says hi, Kay. Steve Wolfbrandt, that is. Carmen says, Good to see you, and Bonnie Boo as well. Hello, Bonnie Boo.
Hi.
Okay, so let's get started. I've got a little bit of a potpourri tonight. I did hear one thing that's good, and that's not on the schedule. And that is, there was something on Rising today, not on Crystal and Sager, but not on Breakpoints, okay, but on Rising. There was an interview of Ro Khanna, okay, and also Ryan Grimm. They both were getting into a conversation at the same time with Emily Dershinsky and this other guy they're trying, whose name is Rogero. I forget what his name is Colin Rogero. That's what it is. I've seen him a number of times on there. Sometimes he can be good. Anyway, Rising is trying out some new hosts, but that's not the story here. The story here is that Ro Khanna suggested that the progressives in the House would not vote for an infrastructure bill until they passed a reconciliation bill, including the climate priorities which the progressives wanted to see in an infrastructure bill. They said they would vote against Ro Khanna said they would vote against a bipartisan infrastructure bill, keep on voting against it until the infrastructure bill dealing with the climate was passed as a reconciliation bill. He specifically said they would not trust a promise by the Senate to pass a climate bill after a bipartisan infrastructure bill was passed. If that's true, and if the CPC holds firm on that, 40 or 50 CPC members, then Biden is going to have to start hammering away at the senators to get such a bill passed. He won't have any alternative then. He's going to have to start getting tough with the people that he needs to get tough with. So let's keep that in mind as we go forward tonight. I'd like to begin with a piece from Truth Out on public banking. This is public banking can improve the lives of U.S. workers while helping save the planet. And this is a piece by C.J. Polychroniou of Truth Out on June 9th. And C.J. is interviewing, let's see who he's interviewing about this. The movement to create public banks is gaining ground in many parts of the U.S., particularly among activists and progressive lawmakers, to extend banking access to low-income communities and communities of color in the post-COVID-19 economy. But how does public banking help protect the local community and assist with the development? If public banks become part of the Federal Reserve, as a bill introduced by Representatives by Rashida Tlaib and Alexandra Ocasio-Cortez aims to do. By the way, that's clearly an MMT-inspired bill, by the way. What would be the consequences? Leading progressive economist Gerald Epstein, professor of economics, co-director of the Political Economy Research Institute at the University of Massachusetts at Amherst, has studied the issue of public banking extensively and sheds ample light on these questions in this exclusive interview for Truth Out. And there's CJ starting off with a question. After a series of ups and downs, the movement for public banking is gaining traction in states in the United States. Why do we need public banks, and why are they a better alternative than private banks? Well, Gerald Epstein says, first off, when I discuss a public bank or a public banking and finance institution, I generally mean a financial institution that has public support, has a social or public goal, and is not driven mainly by a profit motive. I have a little different take on that. When I discuss a public bank, what I mean is a bank that has those characteristics, but also is publicly owned by a state or a local community. That's what I think a public bank is. Why do we need public banking institutions? Plenty of reasons. Private banks charge excessive fees for simple banking services. Asset management companies and financial advisors have major conflicts of interests. Banks engage in highly risky activities, expecting bailouts when they get into financial trouble. Private equity firms strip businesses and households of their assets by loading them up with debts, leaving them without the wherewithal to pay decent wages or compete with other companies. The public provision of financial services is important not only because it can do what the current financial system does not do, but it can do better at many of the things that private finance purports to do. A public banking and financial institution could help restructure the financial system to better serve public needs, especially the short-term and long-term needs of the poor, the working class, and the planet. Here are some important functions that a public banking and financial institution could play in our economy. Competition and regulation. Public options compete with existing financial institutions, thereby providing people with alternatives to private finance and possibly improving the products and services that private finance offers. The public option also provides a means of regulating private financial institutions through competition. It does, but there's always a fine line here. If the public option is really competitive, if the public options are really competitive with the private financial institutions, there's every chance that they could drive the private financial institutions out of business, isn't there? Not that I'm saying that's bad. Not that I'm saying that's bad. But of course, that's exactly what the private institutions are going to think. And that's why the private institutions are going to be really in opposition and are in opposition, basically, to public banks. 2, public goods. Public goods such as a highly educated population, efficient infrastructure, and long-term technological innovation with broad positive spillovers can be supported by public finance institutions. Yes, indeed. That can be great things public banks can do. Collective goods and complementarities. Collective goods are those that require concerted and collective action to come to fruition and generate productive outcomes. For example, as Mirza Baradaran, that's a mouthful, Mirza Baradaran argues in developing her proposal for, quote, a Homestead Act for the 21st century, providing affordable housing is not sustainable in and of itself because there are a number of complementary goods that might be available at the same time, such as jobs, financial institutions, and grocery stores. Here, community development is a good that must involve collective planning and simultaneous financing in a number of different areas for any of the pieces to succeed. A public banking and financial institution can be a useful mechanism to coordinate and help finance these activities. Financial inclusion, fighting poverty, exploitation, and racial discrimination. Financial exclusion, exploitation, and racial injustice are deeply ingrained social ills in the United States, and I'm afraid in our culture as well. Public banking, I said that, of course. Public banking and finance institutions can help finance affordable housing, cooperatives, small business, education initiatives, and financial services, all in communities of color and for institutions owned or controlled by members of the community. Financial resilience and stability. Public banking and finance institutions, by contributing to a more diverse financial ecosystem, help to make the financial system more resilient and robust. For example, unlike for-profit banks, publicly owned financial institutions tend to perform countercyclically, helping to stabilize the economy rather than exacerbating crises, as of course our commercial banks do. They exacerbate crises through speculation. We certainly saw that in the run-up to the financial crash of 2008 and 2009. Economic transformation. For large-scale transformative issues, the social provision of finance must play a major role. These include projects that have long-term gestation periods, massive uncertainty, large economies of scale, and the need for complementary investments and planning. Okay, this is the answer Gerald Epstein is giving to C.J. Polychroniou. One example is the pressing need to make the transition to renewable and non-carbon producing fuels, such as the Green New Deal. Well, the Green New Deal is more than that, but yes, it is about a transition to renewable and non-carbon producing fuels. This requires investment in new technologies and infrastructure implementation. In such a multifaceted, transformative endeavor, public provision of finance is crucial as a facilitating mechanism and a planning tool. Promote full employment and good jobs. Credit allocation is key for job creation, including areas of structural unemployment, as well as patient capital for long-term gestation projects and infrastructure investments. Here, the quality of employment is as critical as the quantity. That is, quote, high road, unquote, employment. Number 8, instrument of public policy. In an economic transformation like the Green New Deal, a public provision of credit is a powerful instrument of government policy. Countries that have made successful, rapid, and transformative economic changes, including the United States, South Korea, Taiwan, China, and Western European countries such as France, Germany, and Italy, in the first few decades after World War II all used the public provision of finance as a carrot or a stick to elicit desired corporate behavior and allocate credit to priority sectors. In other words, they used public provision of finance as an instrument of industrial policy to support development. Number 9, reducing the power of financial elites and countering capital strike. Among the most important effects of a public banking and financial institution, and a key reason that capitalists often oppose it, is that having a public option reduces the market power of private capital and the political power of finance. As private banks and other financial activities in the United States have become bigger and more concentrated, social provision of finance will confront these oligopolies with more competition. Politically, public options reduce the power of the threat of a capital strike and of being, quote, too big to fail, unquote. With a large public banking and financial institution footprint, we can say to Wall Street, quote, go ahead and fail. Our public financial institutions will provide the needed services without you, unquote. I like that. Don't you, everybody? Don't you like that? Moreover, public banking and financial institutions provide a counterweight if private finance threatens capital flight in response to progressive policies they don't like. Oh, so you guys want to go over to Europe and settle there and take your corporate headquarters there? Well, go ahead and do so. Then you won't get to practice in the United States anymore at all. How do you like those apples? Can public banking and finance institutions thrive and survive in a capitalist economy? Capitalist economies, especially those dominated by neoliberalism, would seem to be a uniquely inhospitable place for public banking and finance. Yet, as Thomas Marwah has documented, there has been a dramatic increase in public banking and financial institutions, the prevalence around the world in recent decades. According to him, over 900 public banks already exist. Not in the United States, though, folks. Altogether, they control more than 20% of all bank assets, public and private. I didn't know that, but that is good to know. While it is true that public control of banking assets has probably fallen from its 1970s height of around 40%, today's economies are much bigger, and the total mass of public bank capital has grown substantially. Latest estimate by Marwah shows that public banks have combined financial assets totaling nearly $49 trillion, which equals more than half of global GDP. That is a substantial amount. How can public banking and financial institutions continue to thrive in the apparently hyper-capitalist environment of most countries? Two factors are pivotal. The first one has to do with the recent decades of financial crises, which have led to the growth of these public institutions to rescue finance, if not the economy as a whole. The second may be a bit more surprising. In some ways, these institutions are actually more efficient and safer than the private financial institutions. So, by the way, in the Twitter discussions that have been going on related to the efforts in Washington to pass a single-payer bill, there have been some claims by certain people that the funding mechanisms in the bill are a little uncertain. Okay, the person who's claimed this hasn't really been very specific about the uncertainties yet. But first thing I thought of when he said it was uncertain, one of the first things I thought of anyway, was, why doesn't the state of Washington start a public bank? then the public bank could provide a backup for the public funding of the Medicare for All program. If it were part of the Federal Reserve, and the Federal Reserve, and the Federal Reserve would commit, to not allowing it to fail, then that would certainly be a source of extremely secure funding. Anyway, going back to the article, despite mainstream economics claim to the contrary, there are some competitive advantages of these public institutions that allow them a fighting chance even in the capitalist marketplace. They are the following. Public banking and finance institutions tend to emphasize relationship banking so that bankers and customers get to know each other well. This increases knowledge of credit risk and enhances trust, thereby reducing manipulative or fraudulent behavior on both sides. True. 2. Public mandates and lack of shareholder control typically lead public banking and finance institutions to adopt less risky behavior than their private counterparts. This can result in less instability, access to capital at lower cost. Many public banking and finance institutions have lower costs for capital because they are perceived as being safer than private banks that engage in high-risk activities. They tend to build capital through profit retention, since they're not under pressure to distribute dividends to shareholders, and they do not face the same shareholder demands for rapid expansion. 4. Public mandates lead to banks passing on advantages to customers. Public banking and finance institutions passed on lower expenses to customers rather than needing to pay extraordinarily high executive salaries and large amounts of dividends. This attracts more borrowers and more depositors and lenders. Economies of scale. Even though relationship banking and a tight monitoring of credit risks can be very costly, public banking and finance institutions can achieve economies of scale by joining networks that provide services like underwriting, technical assistance, and help identifying lenders and good borrowers. Such networks can at least partially erode some of the advantageous economies of scale that large private firms have. That may be, but a state bank of California would certainly have some great economies of scale going for it, wouldn't it? Still, this kind of banking seems stunted in the U.S. relative to some other places in the world, but I would argue that this is because private banking gets massive subsidies from the U.S. government, including the Federal Reserve, that mostly are not available to public banking and finance institutions. It will take political mobilization to change this, and thankfully that mobilization is beginning to happen. What kinds of grassroots initiatives are currently going on in the fight for public banking? Public banking initiatives in the U.S. have gained unprecedented momentum in recent years. The origins of the resurgence of interest in public banking go back to the Occupy movement, which emerged in 2011 as a response to the economic and social injustices heightened by the global financial crisis. The infrastructure crisis, the exclusion of millions of Americans from basic banking services, and private banking's long-standing history of financing environmental harmful projects have further fueled interest in public banking across the United States. As a response to these problems, public banking advocates have started state and local initiatives to establish public banking institutions in a number of localities. Alongside of these initiatives, networks of organizations and advocacy groups have been created. The Public Banking Institute, which is run by Ellen Brown, the California Public Banking Alliance, and the National Public Banking Alliance are among the major think tanks and organizations advocating for public banking. These organizations have forged connections with the panoply of non-governmental organizations and grassroots movements to help develop existing coalitions and mobilize support. Advocates working toward establishing public banks follow two common approaches. The first approach is to establish public banks at the city, county, or regional level. In most cases, the state governments need to pass by legislation to authorize the creation of local level public banks. The second approach involves establishing a state public bank, like the Bank of North Dakota, which would act as the public depository for state funds and partner with local lenders. There are attempts in different states to establish public banks following both of these approaches. These efforts are spread throughout the country. Here's a brief rundown. New York State and Pennsylvania host initiatives to establish public banks at local and state levels. Both states are working towards passing a bill that would provide the legal background for local governments to establish their own public banks. In Pennsylvania, this by legislation will be used to establish a city public bank in Philadelphia. Besides, both states are pursuing by legislation to establish state-level public banks. The advocates in Pennsylvania working closely with the Public Banking Institute to establish a public bank following the Bank of North Dakota model. These efforts are supported by numerous grassroots groups in both states. Washington State is another important hub for public banking advocacy. Over the past several years, advocates have been pushing to establish a state-level public bank that would function as a public depository for state money and would be authorized to manage and invest state funds in infrastructure development programs. Although these efforts have been facing fierce ideological opposition, particularly from the state treasurer, the organizers who participated in our survey expressed their commitment to continue pushing for public banking in the coming years. Besides these three states, there are efforts to establish state-level public banks in 9 other states: California, Hawaii, but also Maryland, Massachusetts, New Jersey, New Mexico, Oregon, and Virginia. Even here in Virginia. The most significant victory for the public banking movement took place in California in 2019 as the legislation enabling the creation of local public banks, AB 857, passed. This is the first actual municipal banking legislation in the country, authorizing the state to charter 10 municipal banks over 7 years. There are also ongoing efforts to convert California's Infrastructure and Development Bank, the iBank, currently an infrastructure loan fund, into a state-level public bank. The lack of alternatives to Wall Street banks gave rise to the public bank LA initiative, which began a campaign to establish a municipal bank that would be owned by the city of Los Angeles and would manage city funds in the public interest. One of the first major accomplishments of Public Bank LA was to facilitate a city referendum to form a public bank. Although the referendum fell short at 44.15% support, this momentum was translated into the formation of the California Public Banking Alliance, which is a coalition of 10 public banking grassroots groups across the state. Because local public banking advocates in California have been campaigning for a state-level public bank, these efforts started in 2019 with the introduction of a bill, SB 528, by Democratic Senator Ben Pueso. This bill aimed to transform the iBank into a depository institution that could take deposits from cities and countries, manage them, and provide loan guarantees and conduit bonds to California projects. After the failure of this bill, a new task force started working on converting the iBank into a state-level public bank. In July 2020, a new bill, AB 310, was introduced for this purpose. AB 310 has two main components targets: expanding the iBank's lending capacity and converting the iBank into a state public bank. The expansion of lending capacity was introduced to support local governments and small businesses, targeting especially those owned by disadvantaged groups. Overall, California can be considered as a center of public banking advocacy work in the United States. There is a large and growing public support for public banking, and the advocates have been successful in building coalitions, forming organizations, and introducing legislation. By following these developments and building dialogue, advocates in other parts of the country can take important lessons from the victories and challenges faced by public banking organizers from California. Still, without broader public support, such as what the government gives private banks, these public banks will always be at somewhat of a disadvantage. Thankfully, a number of progressive legislators and activists are pursuing initiatives at the federal level to support public banking and finance institutions and activities. Bill H.R. 8721 was introduced. Here's a question from C.J. Policroniu again. In October 2020, to provide for the federal charter of certain public banks, what would be the role of a public bank created by the federal government? Could it provide an effective pathway toward financing the green transition? The Public Banking Act, a federal bill introduced to Congress in October 2020 by Representatives Tlaib and Ocasio-Cortez, speaks directly to some of the demands expressed by public banking advocates in our survey analysis. The Public Banking Act aims to enable and encourage the creation of public banks at state and local levels by establishing a comprehensive federal framework to regulate the banks, grant programs, and support for the financial infrastructure. In other words, this bill encourages the creation of public banks by providing, quote, top-down, unquote, support for, quote, bottom-up local initiatives. Under the Public Banking Act, public banks can become members of the Fed. In addition, this legislation presents a pathway for state-chartered banks to gain federal recognition and identifies a framework for public banks to interact with postal banking, where the USPS serves as a bank, or Fed accounts, where everyone gets an account with the Fed through which they could receive direct payments such as stimulus checks from the government. The bill also introduces lending rules and regulations regarding excluded and marginalized groups, ecological sustainability, and data reporting. For instance, it prohibits public banks from engaging in or supporting fossil fuel investment. Besides, it directs the Fed to develop by regulations and provide guidance to ensure that public banks' activities remain consistent with climate goals and universal and comprehensively include historically excluded and marginalized groups. Key feature of the Public Banking Act is that it recognizes the need for more federal level support for local and state level public banking initiatives. The legislation also shows that the Fed and the Treasury can be instrumental in supporting the financial infrastructure outside of their typical models of action. There are other possible federal initiatives to help finance a Green New Deal. The Federal Reserve itself could buy green bonds, as suggested, for example, by Professor Robert Pollan, or the government could create a freestanding, quote, green bank, unquote, at the federal level to mobilize private capital and combine it with public monies to help fund the green transition. Finally, some have proposed the creation of a federal infrastructure bank. Robert Hockett, and presumably this bank could be restricted to funding only climate-friendly investment. All this could greatly complement initiatives at the state and municipal levels to promote solutions to the climate emergency. So, that's a fairly comprehensive article, extremely informative, and extremely hopeful about the future of the public banking movement. And who knows, it might be of use to many states, including activists in Washington state itself, who are pushing a state-based bill that would implement a universal health coverage program that they call a Medicare for All program, and that to all intents and purposes looks similar in many ways to a Medicare for All program. Going on. This kind of feeds into environmental concerns, as we have already seen. And here's a post, again from Truthout. That is entitled "Labor Unions Rally Behind California's Zero Emissions Climate Plan." There's a picture, obsolete, sunset for fossil fuels. That's climate activist holding a sign during a climate strike youth protest outside Chevron headquarters on September 27, 2019. And this is another piece by C.J. Polychroniou, but now he's interviewing Professor Pollan, Robert Pollan, Distinguished Professor of Economics and co-director of the Political Economy Research Institute at the University of Massachusetts, at Amherst, who has been spearheading national and international efforts to tackle the climate crisis for more than a decade. Over the past few years, he and a group of his colleagues at PERI have produced green economy transition programs for numerous states. The latest such program is for California, and it is being released today. The massive study, nearly 200 pages long, I don't know how massive that is, shows how California can become a zero emissions economy by 2045. That's too late. While expanding good job opportunities throughout the state. 19 unions have already endorsed the Green Transition Plan, making clear that they reject frameworks that falsely pit labor priorities and the environment against each other, and more are expected to do so in the days and weeks ahead. In this interview for Truthout, Pollan, co-author with Noam Chomsky, of Climate Crisis and the Global Green New Deal, a Political Economy of Saving the Planet, which is from Verso 2020, talks about the Climate Stabilization Project for California and the national implications of union support for a green economy transition. And C.J. Polychroniou then asks his first question, of Pollan. California's been at the forefront of the climate fight for years now, but the truth of the matter is that its efforts have fallen short. Now you and some colleagues of yours at PERI have just completed a commissioned climate stabilization project for California. How does the project envision the clean energy transition to take place in a manner consistent with the emission targets set out by the UN Intergovernmental Panel on Climate Change, IPCC, 2018, and how will it be financed? Bob Pollan replies and says, this study presents a recovery program for California that will also build a durable foundation for an economically robust and ecologically sustainable longer-term growth trajectory. California has long been a national and global leader in implementing robust climate stabilization policies. This includes the 2018 Executive Order B5518 by then Governor Jerry Brown. This measure committed the state to cut CO2 emissions by 50% as of 2030, to become carbon neutral no later than 2045, and to produce at negative emissions thereafter, at net negative emissions thereafter. These goals are somewhat more ambitious than those set out by the IPCC in 2018. Our study outlines a program through which the state can achieve its own established goals. Our study shows how these 2030 and 2045 emissions reduction targets can be accomplished in California through phasing out the consumption of oil, coal, and natural gas to generate energy in the state, since burning fossil fuels to produce energy is by far the primary source of CO2 emissions and therefore the single greatest factor causing climate change. The project we propose is to build a clean energy infrastructure to replace the existing fossil fuel dominant infrastructure. The clean energy infrastructure will require large-scale investments to first dramatically raise energy efficiency standards in the state, and second, to equally dramatically expand the supply of clean renewable energy supplies, including solar and wind primarily, with supplemental supplies from low emissions, bioenergy, geothermal, and small-scale hydropower. We show how the climate stabilization program for California can also serve as a major new engine of job creation and economic well-being throughout the state, both in the short and longer runs. We have scaled the clean energy investment project at about $76 billion per year on average between 2021 and 2030. That's just for California, remember. This will equal roughly 2% of what we estimate will be the state's average GDP between 2021 and 2030. In other words, California can hit its emissions reduction targets through maintaining clean energy investment spending at levels at about 2% of overall economic activity in the state. That's cheap, and also probably far less ambitious than it ought to be. That means that roughly 98% of the state's annual economic activity can still be focused on anything other than clean energy investments. But the state must maintain this 2% of GDP investment level in clean energy for the program to work. We estimate this level of investment will generate roughly 420,000 jobs throughout the state's economy. New job opportunities will open for, among other occupations, carpenters, machinists, welders, electronic equipment assemblers, environmental scientists, administrative assistants, accountants, truck drivers, roofers, and agricultural laborers. Investments in public transportation, a major component of the energy efficiency investment program, will produce public sector jobs for drivers and managerial staff. The quality of these jobs, including wages, benefits, and levels of unionization, vary by sector. In general, it will be critical to raise job quality standards as the number of jobs available expands. Raising the rates of unionization, as well as expanding job training programs, will all be crucial for raising overall job quality levels. Local hire provisions and related measures will also need to be implemented to ensure equitable access by race and gender to the expanding job opportunities. While focusing on the clean energy investment to reduce California's CO2 emissions by 50% as of 2030, our study does also examine how the state can achieve its longer-term goal of becoming a zero-emissions economy by 2045. The basic features of the investment program between 2031 and 2045 can be extended from the 2021 to 2030 framework. But in fact, the scale of the investment spending required to achieve the 2045 zero emissions target can be somewhat more modest, averaging around 1.3% of the state's GDP between 2031 to 2045. Our study also examines a complementary investment project to upgrade California's economy based through manufacturing infrastructure, agricultural investments, and also land by restoration. We budgeted this program at about $62 billion per year, or 1.7% of the state's GDP in these areas. This investment program is based on the proposed National Thrive Agenda, a bill introduced into the U.S. Congress in February of 2021 by Senator Ed Markey and Congresswoman Debbie Dingell, Democrat of Michigan, to, quote, transform, heal, and renew by investing in a vibrant economy. That's Thrive, right? THRIVE. To date, the Thrive Agenda has been endorsed by more than 100 members of Congress and hundreds of major union, racial justice, and climate organizations. We estimate these investments will generate about 626,000 jobs throughout the state in a wide range of occupations. When we bring together the combined investment programs in the areas of energy efficiency and renewable energy, along with public infrastructure, manufacturing, and land restoration, agriculture, total spending in California comes to an average of about $140 billion per year, equal to a bit less than 4% of California's average annual GDP between 2021 and 2030. This level of job creation would generate about 1 million jobs within California. The higher level of job creation will then be sustained through the full decade as long as the budgetary levels for the range of investment programs are maintained. The expansion in job opportunities will equal more than 5% of California's 2019 labor force. This means that if California's unemployment rate was, say, 7% without this combined investment programs, these investments would drive unemployment to something in the range of 2%, i.e. to reach something close to full employment in the state. An absolute front and center feature of our proposal is the Just Transition Program for the state's fossil fuel-dependent workers and communities. That 112,000 people are employed in California in fossil fuel-based industries, amounting to about 0.6% of the state's total workforce in 2019. Workers in the state's fossil fuel-based industries will, of course, experience job loss as the state dramatically reduces consumption of these CO2 generating energy sources. We estimate that about 3,200 workers per year will be displaced in these industries in California between 2001 to 2030, while another 2,500 will voluntarily retire each year. It is critical that all of these workers receive pension guarantees, health care coverage, reemployment guarantees, along with wage subsidies to ensure they will not experience income losses, along with retraining and relocation support as needed. By enacting a generous Just Transition Program for the displaced fossil fuel-based industry workers is especially important. We estimate that the cost of a generous Just Transition package for all fossil fuel industry-based workers experiencing layoffs would come to about $470 million per year. This is equal to about 0.02%, 0.02% of the state's average GDP between 2001 and 2030. Three counties in California, Kern, Contra Costa, and Los Angeles, account for roughly half of all employment in the state's fossil fuel-based industries. Kern County in particular will face the most significant proportional impacts from the phase down of the state's fossil fuel industries. We therefore present a focused discussion on providing community transition support for Kern County. In fact, we found that some initial stage activities are already underway in Kern to move the area away from its current level of fossil fuel-based industry dependency and to build there a clean energy production infrastructure. How do you pay for the whole thing? It's actually straightforward, especially as we keep in mind that overall, we're talking about devoting less than 4% of the state's overall economic activity to these investment projects. And the most critical purpose of these projects is, after all, just to achieve the state's own CO2 emissions reduction targets. Of the roughly $140 billion per year in combined investments and the Just Transition Program, we assume that roughly half of total spending, about $70 billion each year, will be provided by private investors, while the other half is supplied by public spending. Private investments in the clean energy areas in particular will be incentivized by the federal and statewide regulatory environment. A significant share, if not the majority, of the approximately $70 billion per year in public spending is likely to come from a version of the Biden administration's proposed American Jobs Plan, which is focused on infrastructure and clean energy investments. Those are exactly the things that Biden has been talking to the Republicans about sacrificing, and the kinds of things that Ro Khanna was saying will have to pass before any bipartisan infrastructure bill passes. The state of California could then provide, to go on with the article, the additional funding is needed. The fact that the state can borrow at very low interest rates now is critical. As an example, we show that if the state government issues $30 billion in bonds in the current low interest rate environment, the debt servicing burden will also be low, i.e. in the range of 0.3% of the state's annual general revenues. It follows that even if the federal government's funding through the final version of the Biden American Jobs Plan comes in at a relatively low level, the state of California could still provide the additional financing through issuing bonds in the current low interest rate environment without imposing a major burden on the state's overall budget. And of course, that issuing of bonds would be greatly facilitated by having a state bank of California there to help with the financing. The project has been endorsed by 19 unions across the state of California. More are expected to join. This is undoubtedly a highly significant development. This last is a question from C.J. Polychroniou, but given that only around 16% of the total workforce is actually unionized, isn't there a need to reach out to the rest of the population for support? For decades now, says Pollack, wide majorities of people in California have been supporting strong measures to protect the environment and combat climate change. Increasingly, also, the state is suffering disproportionately from the effects of the climate change. And more generally, from burning fossil fuels to produce energy, including wildfires, droughts, floods, heat waves, and air pollution that are all becoming more severe over time. The National Oceanic and Atmospheric Administration, known as NOAA, estimates that just since 2012, California has experienced roughly 16, quote, billion-dollar disaster events, unquote, generating economic losses of over $100 billion in total. Beyond these climate-specific considerations, it is also the case that the Clean Energy Investment Program will deliver lower energy costs to all consumers in California. This is first because raising energy efficiency standards will enable consumers to spend less money for a given amount of energy services, e.g., to heat, cool, and light homes, or to drive from Riverside to LA. In addition, the costs of wind, solar, and geothermal power are all roughly equivalent to or lower than those for fossil fuels and nuclear energy, and are falling significantly. As such, the average California household should be able to save nearly 40% on their overall annual energy bill relative to what they spend now in the current fossil fuel dominant system. In short, everyone in the state has a personal stake in solving the climate crisis, even those who aren't particularly concerned with the most fundamental matter of saving the planet. Can you speak about the national implications set by the union support in California for the climate stabilization project you and your colleagues have designed? The union movement has increasingly embraced a major leadership role in advancing green transition programs. I've worked with the leadership of the AFL-CIO on these issues in multiple states. The level at which California unions have supported our study is one major step forward, and I am, of course, extremely pleased by the support, but is also part of a growing trend that has been advancing due to the work of outstanding, committed organizers throughout the country. When I first started working on these issues 14 years ago, the prevailing view in mainstream circles, not the labor movement, but in the circles of high-powered policymakers, academia, and the mainstream press, was that there is a huge and unavoidable trade-off between jobs and the environment. You could have one or the other, more jobs or a cleaner environment, but you can't have both, so choose one. Over the last decade, lots of very effective labor movement activists, from the grassroots level to many top officials, have pounded home the reality that this is a false trade-off. Due to their efforts, this message has now penetrated all the way up to the Biden administration. Note that Biden is calling his clean energy program an American Jobs Plan. This is really highly encouraging news in the battle to tame global warming. So I must ask, this is C.J. Polychroniou again, what's next in line in terms of stabilization projects? And Bob Holland says, my coworkers and I at Peary are continuing to work with different groups to advance robust climate programs at the national, state, as well as county and community levels. Separately, I'm working on green transition studies for other countries, Greece being one of them. In the case of Greece, I'm looking forward to working more on the issue of land use requirements in building a green energy infrastructure, building from the outstanding work on this question by the Harvard physicist whose name is Mara Prentice. The issues here is, it should be, the issues here are, or the issue here is, do we really have to locate wind turbines on top of the most beautiful, pristine mountain cities in Greece in order to build a green economy? This is another one of the false trade-offs that lots of people in power want us to believe. I'm also working on issues of financing the global Green New Deal in developing and in middle-income countries, especially in Asia, in conjunction with the UN Conference on Trade and Development. That in addition to trying to maintain the solar panels at my house and office reasonably well. And that's the end of that piece, which I thought was a very, very exciting piece about his activities, okay, in the climate area. Notice he did not mention the role that might be played by public banking in California in implementing the Green New Deal there. That could be very significant. And so that's one reason why I see a close relation of this article to the previous one, okay, by Gerald Epstein on public banking. And next, I wanted to cover an article from Common Dreams called Climate Denial Masquerading as Bipartisanship. And there's Ed Markey holding the Green New Deal sign. Not actually holding it, I'm sorry. The Green New Deal sign is at the top of the podium that he is speaking at. This was from a news conference on Tuesday, April 20th, 2021. And you'll notice Ocasio-Cortez is there, and Congressman Garcia from California, and Cori Bush, Ed Markey. I'm not sure who these other people are in the background, but they were there. The title of this article is Climate Denial Masquerading as Bipartisanship. That progressives reject latest infrastructure compromise. And the article is by Jake Johnson and was done on June 11th. The progressive rallying cry of, quote, no climate, no deal, unquote, continued to gain steam Friday in response to the emerging details of a bipartisan infrastructure proposal that calls for just $580 billion in new spending, a sum that climate leaders in Congress and at the grassroots rejected as woefully inadequate, as of course it is. And Representative Jayapal said, no way I'm supporting an infrastructure package that doesn't invest in fighting the climate crisis. Well, the bipartisan group of senators led by Mitt Romney, Joe Manchin, Kirsten Sinema, and others has yet to fully flesh out its plan. Early indications suggest the proposal will fall well short on green energy investments and other climate initiatives that progressive lawmakers view as essential priorities amid soaring temperatures and record levels of atmospheric carbon dioxide. John Tester, senator from Montana, a member of the bipartisan group, told the Washington Post on Thursday that the tentative new framework will include proposals to combat the climate crisis, but predicted some lawmakers will view the plan as not adequate, quote unquote. Not just some lawmakers, most people. As news of the bipartisan plan began to trickle out Thursday evening, progressive lawmakers made clear they were not impressed. Quote, "It sounds like to me they have a package which is climate denial masquerading as bipartisanship," unquote, said Senator Markey, the lead Senate sponsor of the Green New Deal resolution. He said this in an appearance on MSNBC. Quote, "We can't have an infrastructure bill in 2021 that doesn't have climate at its center. No climate, no deal," unquote. They better not cave this time. Markey's, quote, "no climate, no deal" mantra was soon echoed by progressive advocacy organizations and other members of Congress who said they would not be willing to vote for any infrastructure package that skips on climate action. With razor-thin margins in the House and Senate, Democrats can ill afford any defections. "No way I'm supporting an infrastructure package that doesn't invest in fighting the climate crisis," tweeted Jayapal. "Who's with me?" On Friday, Senator Jeff Merkley warned that refusing to act on climate means selling out the future generations. He also said, quote, "the future of our planet and the health of our communities are non-negotiable," unquote. Sunrise Movement tweeted, "Since at POTUS and company want to play games, senators from across the country are leveraging their power and saying no climate, no deal. The climate crisis is here. What are we going to do about it?" As the Washington Post reported, Biden's original $2.2 trillion American Jobs Plan proposed roughly $1 trillion in clean energy tax credits, support for electric vehicles and their charging infrastructure, the research into breakthrough green technologies, and a new jobs program to restore public lands and plug abandoned oil and gas wells, among other climate-related measures. But as infrastructure negotiations with the Republicans and conservative Democrats have dragged on in recent weeks, Biden administration officials signaled some of the climate provisions in the president's opening offer could be abandoned in an effort to win support from GOP lawmakers, many of whom continue to deny the reality of human-caused climate change. With the legislative filibuster in place, Senate Democrats would need the support of at least 10 Republicans to pass a bill through regular order. Alternatively, Democrats could use the arcane budget reconciliation process, which requires just a simple majority vote to pass an infrastructure package on their own. But Manchin, whose vote is necessary if Democrats opt to proceed on a unilateral basis, has voiced opposition to pursuing a reconciliation package without Republican backing. In other words, he's voiced opposition to using reconciliation. But Rania Epting, executive director of the Progressive Advocacy Group, Move On, said in a statement Friday that, quote, "the idea that Republican senators will support anything close to what is needed in this moment is simply not realistic," unquote. "But we've waited long enough. Now's the time for action," said Epting. Quote again, "Republicans are more interested in obstructing and delaying Biden's agenda than solving today's problems. Neither those who need this help nor Democrats in Congress have one more minute to waste with Republican obstruction." So, time is growing short, of course. Here's another one I thought was important to bring to your attention. This one is about taxing the rich. Of course, we know we don't have to tax them for revenue, at least not at the federal level. But we do have to tax them for democracy. because they are spending a lot of money to undermine democracy. So we got to know if we want to stop them from spending quite so much. We have to, in the words of this article, stop pretending it's impossible to tax wealth. It's by Ryan Cooper, June 10th. Turns out many of the very richest Americans pay almost nothing in taxes. A staggering report from ProPublica shows that between 2014 and 2018, Jeff Bezos, Warren Buffett, Michael Bloomberg, and Elon Musk paid between 0.1% and 3.27% on the overall increase in value of their fortunes, largely because under current law, capital gains are not taxed until they are sold or transferred. In response, a lot of billionaire apologists have condescendingly explained that this all is no big deal and critics should shut up. This quote was the worst thing I've ever read by ProPublica, and a real contender for the worst thing I've read so far in 2021 from a credible outlet, unquote, writes Jeremy Arnold in his Saving Journalism newsletter. At Reason, Andrew Moylan and Andrew Wilford accused ProPublica of deceiving the public, the, quote, service of the grand progressive campaign for higher taxes. Such critics argued that it is impossible or undesirable to tax wealth. In reality, not only is it easily possible and good to do so, the fact that billionaires have so much wealth in the first place is the result of policy decisions that structure the economy. Government choices create billionaire wealth, and different choices could get rid of it, at any time. The first oligarch defense strategy is to assert that taxing wealth would be a big administrative pain in the neck. Quote, our tax system rightly does not tax growth in one's wealth until it is realized as income, writes Andrew Moylan and Andrew Wilford. Quote, after all, the alternative is a monstrously complex and unfair system of wealth taxation that developed countries have avoided, unquote. This is wrong on multiple levels, says Ryan Cooper. First of all, most middle-class Americans already have to pay a wealth tax imposed at the state and local level. These account for about 12% of total American tax revenue, though rates vary widely between states, which is actually about twice the average of OECD nations. Second, several countries have wealth taxes today, or have had today in the OECD. Colombia, France, Norway, Switzerland, and Spain have some kind of net wealth tax, and even more countries had them previously. The decline of wealth taxes in Europe ties into a second oligarch defense that such taxes decrease growth by inhibiting investment. Quote, taxpayers with a high net worth would be encouraged to consume their wealth instead of using it productively, depriving the federal government of revenue and reducing economic growth, unquote, argue Erica York and Garrett Watson at the Tax Foundation. That is indeed what neoliberal economic theory says, but there is no good empirical evidence for this. As economist Thomas Piketty points out, when wealth taxes and taxes of all kinds were higher and more common, growth rates were higher, not lower. As I have previously argued, there is an overwhelming case that the limiting factor on growth since 2008 at least has been insufficient demand, not insufficiently generous incentives for investment. The economy has been stuck in a mild depression for well over a decade now because most people have had far too little disposable income. It follows that hiking taxes on the rich will tend to provide an economic boost by putting resources back in circulation. As a matter of history, Countries that have axed their wealth taxes did so because of beggar thy neighbor tax competition from other countries and or corruption. Conservatives or neoliberals came to power like Frederick Reinfeldt in Sweden or Emmanuel Macron in France, and cut wealth taxes to give the rich more money, growth be hanged. This is why very few of these growth the warriors, growth warriors, as opposed to the warriors, growth warriors, reconsidered their views when the 2010s saw the worst economic performance since the 1930s, despite very low taxes on corporations and wealth. So a progressive wealth tax would be both fair and easy to set up, as economists Gabriel Zuckman and Emmanuel Saez explain in their book, The Triumph of Injustice. You just need a big wealth by registry that is kept up to date. They calculate that about 80% of the financial assets owned by the top 0 to 1% are in the form of stocks, bonds, by real estate, and other things that have a well established value in the market. Most of the rest is in other assets that may not be easy to buy, but are still transacted occasionally, which establishes a price. Other methods of value estimation could be set up on these by small remainder of wealth. With that information, it would be straightforward to levy a progressive annual tax on wealth, a net of debt. Piketty suggests a rate of 0.1% for those with half the amount K of median wealth, escalating to 10% and 100 times the average wealth. I hope that's 100 times the median wealth, and 90% at 10,000 times the median wealth. Just imagine that. Some folks have 10,000 times the median wealth in our society. So if the median wealth is like 200,000, they have 10,000 times that. Surely they don't need that. The point would be to raise revenue, but also to break up the largest fortunes. Incidentally, this would be a large improvement on the badly outdated American-style property tax, which has barely been changed since the 18th century. In most states, property owners have to pay a tax on the whole value of the property, no matter how much equity they have built up. When someone has just bought a home and hasn't paid off too much of the debt, they can end up paying an effective wealth tax of 50% or more, while older, wealthier people who have already paid off their mortgage contribute much less compared to their ability to pay. A progressive tax on all wealth would be much fairer, cleaner, and more efficient. Third oligarch defense strategy is to portray wealth ownership as something that is natural and somehow metaphysically distinct from income. Of course, Bezos didn't pay much tax while his wealth hoard increased in value by tens of billions of dollars, the argument goes, because he didn't make any income. This is the worst argument of the lot. Income and wealth are political constructs that at bottom are similar. They entitle someone to command over material resources. And since they are constructs, the powerful can easily jigger them around. Oligarchs do this both indirectly by pressuring the political system to lower taxes on the kinds of economic power they have, usually shares in particular firms, and directly by restructuring companies away from wages to workers and towards share buybacks that inflate the value of their own assets. Then they can and do borrow against that wealth for their current consumption. Like, for example, to purchase gigantic mansions with 25 bathrooms or mega yachts. 25 bathrooms, God. But if oligarchs can rig the economy for their own benefit. In principle, it could easily be unrigged. For instance, if Amazon workers were unionized and that union owned a big chunk of Amazon shares, and corporate law stipulated that workers got to elect half the seats on the Amazon board, Jeff Bezos would be worth a small fraction of what he is today. His Smaug-esque wealth mountain reflects political power, namely dictatorial control over a huge company. Taxes on the ultra-rich would reduce that power. But so would other reforms to grant workers a share in the profits they help produce and a say in the management decisions of the company. There is nothing inevitable about oligarchy. And I think I'm going to stop there for what I'm going to say tonight. I thought I would have a chance to go through another of the 3 articles I have relating to democracy and relating to the frozen democracy that we have now, in part due to Manchin and cinema, but of course for other reasons as well. But I won't get a chance to do that here tonight, so I'm going to postpone that to tomorrow, and I'm going to move now to take your comments. So, thank you for staying to comment. And let's go. I took some initial comments. And Kay said, I saw that. Very good. Steve said, hi, Dolores. I'm Steve Wolfbrand. Kay said, Dem senators are swearing to that also. No climate, no deal. Yeah, God, I hope they stick to it. If they don't stick to it, they're going to lose all credibility at this point. They got to decide. No climate, no dice. Steve Gonzo said, Israel's Supreme Court rejects human rights groups that request aid to declare it unlawful for soldiers to shoot at unarmed civilians. That has got to be a violation of human rights. That's got to be a human rights crime, folks. It's amazing that Israel's Supreme Court would not declare it unlawful. Just amazing. What has happened over there? Biden should be getting touch on his own, not be coerced into it. Carmen says tough, but correction. But look, Carmen, okay, it's politics. From his point of view, he's trying to get something done. Manchin and the Republicans have some votes, so he's going to them, okay, to try to get some votes. He figures he has the progressives. Why does he figure he has the progressives? Maybe because they didn't get rid of Nancy Pelosi to begin with. Maybe because they didn't get tough on the $15 an hour being included in the American Rescue Plan. Maybe they haven't gotten tough on anything yet. So, maybe that's why they have to get tough. Carmen says, a credit union. Are the credit unions public banks? I don't think so, because they're not owned by the public. Now, most credit unions are cooperatives, so they are owned by portions of the public, yes, but they are not public banks. They're not state-owned banks or city-owned banks. And, of course, they're not part of the Federal Reserve System. Carmen Muna says, have you heard about BlackRock buying up a majority of property, even overpaying asking price for majority ownership. Aren't they the private fascist the security forces? No, I think you're thinking of She there. In other words, the company now known as She that used to be owned by Eric Prince. I think they still are owned by Eric Prince, who is the brother of Betsy DeVos. Kay says low income and affordable housing should be public good, not corporate owned. Absolutely. Dolores Pierce says Carmen Muniz, yes, I read about BlackRock buying property and overpaying for it. Yeah, they seem to be wanting to dominate the whole small real estate market. And Jeffrey says, I don't think it's a person, Joe. I think it's a troll. I showed him how to access the information because the questions he was asking were stupid and very easy to answer. Yeah, I think it's a person. That I'm not saying that's not a troll. I'm not saying that person is not a troll. But what I want to do is smoke out that person. I want to point up that actually that person has no idea how to start a race to the top. And that what they're really saying all along is they think that the combination of the lack of monetary sovereignty and the race to the bottom dooms whole Washington to fail, in its effort. But this is not true, of course. But that's what he really was saying. And when I tried to corner him on that, I'm assuming it's a him or it could be a she, when I tried to corner her on that, she then started running, the other way. And so I asked, well, why do you say that a race to the top is possible if you don't know how to initiate a race to the top? I mean, everybody knows how to initiate a race to the bottom, right? That's been going on for ages. Any idiot knows about that. But if she really thinks there can be a race to the top, or if he really thinks, there can be a race to the top, then let them tell us how. I think we know how, but I don't think they know how. Kay says, the first local bank I was hooked up with was in NC. It was great, called the Cape Fear Bank. Then they got bought out by South State Bank and ruined the local service big time. And but that bank probably was not owned by a local community. In other words, for example, by the town of Cape Fear, was it? Steve Wolfbrand says, hello, Jeffrey. When I was a kid, I think the post office would open up a bank account for you. I can't think back when the last time was that the post office was offering bank accounts. But if you were a kid when they were still offering bank accounts, then certainly it must even have been into my 20s, because I think I'm a little bit older than you, Steve. And they came to our elementary school and opened little bank accounts for the kids with bank books. More for educational efforts, as we didn't have much money. What a different world that was. Kay says, can't see your comment, Steve. Probably because, no, Steve is on Facebook. You should be able to see his comment. Kay. And Kay says, North Dakota is a public bank for decades. It works well there. Indeed, it does. Well, Gerald Friedman wrote the original H.R. 676, and he also approved our bill, which has been approved by the Washington State Department of Revenue. Well, Jeff, I think that's certainly good. As I said, I think perhaps that Gerald was conservative in estimating the savings because I noticed in some past studies of his, okay, that I've seen, is that he always makes conservative assumptions. So if anybody calls him out, he can easily dismiss the criticisms, which is, of course, good, but that doesn't mean that his estimates, okay, are realistic. In this case, I think the realistic estimates would actually end up in estimating much higher savings than 5 billion to 9 billion per year. But I really haven't studied it in a sufficient amount of detail to be able to say that with any kind of authority. So Russ Goldman says, nice credenza behind you there, Dr. Joe. Yeah, thank you, Russ. We've had that for a long time, since our younger salad days. But we still have it. We've kept it even in this very, very small senior living apartment that we have now. Jeff Denton says we're in the process of printing out a follow-up report by Dr. Gerald Friedman, who authored our bill, as well as the original House bill, but Washington State's SB 5204 has been approved by the Washington State Department, okay, of Revenue. Cool. So I have to look up Washington State's SB 5204 then. Kay says, my comments are all screwed up again tonight. I hate that. Kay says, I think I got comments fixed, at least for now. Shake my head. No more nukes. Kay says, the dumbasses here in Ohio built the Perry nuke power plant right on an earthquake fault. Shake my head. I got to get out of here. You bet. God, right on an earthquake fault. Wonderful. Jeffrey says, the like button on the bottom won't work for me at all, and I was able to like one of Steve's comments, but not Amber's. There's only 6 people watching on Facebook, but the medical industrial complex and all the media are all owned by the same exact nonpartisan, criminalist global banking cartel with an absolute phobia about the truth and about democracy also, Jeffrey. And Kay says, don't see Evelyn Napont here tonight. Neither do I. Steve says, I'm watching Jimmy's live stream about TYT. This is really getting ugly. They in the gutter. Well, you know, TYT has been ridiculous lately, going after Aaron Mate. I mean, what are they crazy? What are they crazy? Who goes after Aaron Mate? He'll cut them to ribbons. You don't go after Aaron Mate because he's always right on the money. Steve says, Kay, you see me now. Kay says, comment on Facebook, Steve Wolfbrand. Can't see them. He is commenting on Facebook. I see that. And Kay says, tax stock holdings. Kay says, don't want to clean 25 bathrooms. Laugh out loud. Well, if you have 25 bathrooms in your house, I'm sure you can afford the people to keep them clean. I doubt the 25 are being used all at once. They're probably, if it's just a family that lives there, I'm sure they can get along with 6 of the 25 bathrooms. Maybe the Octomom would need more bathrooms, but I don't think Bill Gates does. Kay says, Koch brothers are now in the buying up property business too. Jeff says, thank you so much, Joe, for taking the time and effort to study the whole Washington Health Trust. I know I'm pretty defensive, but the more that it is scrutinized, the more the truth comes out that it's not as complicated and hard to implement as the richest people in the world and their minions would like people to think. The more that they attack it, the more attention it gets and more good that comes out of it. The more questions that are asked, the more that our volunteers learn about it. Yep, I remember the elementary school savings accounts. Oh, so you're old also, Jeffrey, huh? Carmen Nunes says, seems there's nothing Dr. Joe doesn't know about. What a treasure. Oh, God. Thank you, Carmen. Jeffrey Denton says federal poverty levels change from year to year in Washington state can be high compared to other states. 5204 is the same bill as I 1362. The I is just our initiative number. Thank you, Jeff, because I've downloaded a copy of I 1362 and have been going through it. And I've been going through Jerry Friedman's economic analysis, which, as I said, I think is really a pretty conservative effort in terms of the assumptions it makes. Kay says, Cenk has been a GOP for the whole time that I know him. So you mean he's been a dino for quite a bit of time. I know he was a Republican to start with, but he claimed conversion. He claimed conversion a lot.
What?
Oh, conversion to being a Democrat. He was one of the original founders of Justice Democrats, and even sunk some money into that. Okay, folks, I think that is all for tonight. I don't see any other comments. Kay says, Cenk has been a GOP the whole time, and I know him. And Kay says, when he was on MSNBC years ago, he was a GOP. Okay, so he started out as a GOP. I know that. Any other comments before I say goodnight? Okay, good night, folks. Have a good night. I'll be back tomorrow with some more good stuff on the In-Depth Show. By the way, please visit my Patreon account every once in a while. I would greatly appreciate it. And Russ Gorman says, good to see you, Dr. Joe. Hugs to Bonnie. Thank you, Russ.
Thanks for the hug.
I certainly appreciate your coming. And Bonnie says, thanks for the hugs. And Dolores says, thank you and good night, all. Kay says, thank you, Joe, and all, for a great discussion. I love you all. And we love you, Kay.
The dishwasher.
Steve Wilbrand said, Jimmy is destroying TYT as we speak. Go to it, Jimmy. We cheer you on. Jeff says, I lobby for Cenk's, but Wolfpack and for whole Washington, but I don't trust Cenk. That is wise, Jeffrey Denton. That is wise, because Cenk is obviously untrustworthy, and so is Anna. So is Anna. Okay, so good night again.